Hey everybody, welcome to the second quarter 2021 macro presentation from Narwhal Capital Management. I'm Andrew Hall, Vice President here and a Portfolio Manager. As always, we appreciate you for joining us. If you have any questions on the content we're presenting, feel free to shoot us an email or get in touch with us in another way. But we're happy to have you. As always, here is a disclosure. The big thing to take away from this is that none of this is specific investment advice. We've spent a lot of time and a lot of effort putting this presentation together, and it does accurately reflect our corporate view of the market as well as the economy, but we're not necessarily calling anyone to take any particular action. With that out of the way, I'm going to turn the microphone over to Ben Nye, our Chief Investment Officer, and he's going to get things running for us.
Thanks, Andrew. Over the last quarter, we've heard a lot of different stories, a lot of different narratives that we've been told by a lot of different people through a lot of different mediums. And the common thread that a lot of these stories have is that there's a heavy dose of truth to a lot of these. And then there's also a heavy dose of uncertainty. And where there is uncertainty, a lot of times these narratives will try to fill in the gaps and try to explain things that and put together some coincident indicators that seem like they fit, but in actuality are a lot of the people's own opinions who are actually coming up with these ideas and narratives themselves. And so what we want to do today is, rather than tell a story, we want to actually explain what's going on. And I think this is especially important in today's environment where storytelling is such a way to collect views, collect people watching your YouTube videos, collect people reading your newsletters or blogs. And we want to kind of cut through that. And so we're going to focus heavily on just what is going on in this presentation. So we're going to start by talking about what are the narratives, especially as it relates to the government, corporations, and the people of the US. And then we're going to move to an analysis of the economy, kind of through the lens of the Federal Reserve, looking first at inflation and then at employment. And then finally, we're going to actually finish by looking at the markets. I think a lot of times people in these presentations will start with the markets and then go to the narrative and use the narrative to explain the market. But instead, we're going to actually say what's going on in each instance. The image to the right is an image of the Kraken. And this is exactly what we saw. I mean, in the late 1700s, there were a few British ships that were lost at sea. And there were also rumors of big squids that were spotted, kind of unexplained events. And what ended up happening was it fed this myth of the Kraken. And this guy by the name of Pierre Denis de Montfort actually drew pictures and wrote stories about it, how 10 British ships were lost at sea due to this. Turns out they were lost in a hurricane. And what we want to do is figure out why something's going on versus making up a mythical beast like the Kraken. So to begin with, on the quote to the right, you can see that a lot of something that I did not expect to happen this year was that CNN Politics would talk about UFOs spotted by the US military and saying that this does not rule out the possibility they're alien spacecraft. 60 Minutes actually ran a story about it. Whether it's true or not, they're certainly filling in gaps there. Something that's unexplained. Yes, it's an unexplained flying object, but is it alien? I think that's definitely an area where the narrative is fitting into the facts as they're presented. So again, we'll talk about government, businesses, and households. We're going to start off with the government storylines that we're seeing right now. First is on the Federal Reserve. Now, the Federal Reserve balance sheet, as everyone knows, has really exploded, but it's actually exploded at a lower rate of change than it did between 2008 and 2010. So when people are blaming the massive increase, an increase in inflation on the Federal Reserve balance sheet, it's important to know that this is not unprecedented in terms of the size and the growth of the Federal Reserve balance sheet. And especially if you look forward into the end of 2021, 2022, the Federal Reserve governors are already talking about tapering their asset purchases and you'll start to see a little bit of a pause similar to what we saw in 2014 and to 2018. That's the plan right now. So when you're talking about an unprecedented growth in the Federal Reserve balance sheet, it's really just an unprecedented size. And we've had unprecedented size before, and we've actually made it through it, and then it becomes normal. And if you look at it compared to the Euro area, you actually see a similar trend. And in fact, they actually weren't able to taper as significantly as we were in the United States between 2014 and 2018. In fact, their balance sheet actually grew over that time and has continued to grow. If you look at the central bank assets compared to the size of the economy, the United States is not anomalous here. The United States central bank assets right now account for about 38% of GDP, which is in line with China. It's in line with the United Kingdom, substantially below that of the Euro area, and then well below that of Japan. So again, the size of the balance sheet is not unprecedented, and the growth of the balance sheet is not unprecedented. Now, there are consequences that we can talk about, but if you're trying to pick a point of where this thing actually blows up and where this is unsustainable, we are not that point. And I don't think we're actually even close to that point at this point in time. There's also been a lot of talk about government debt. Today, the United States has a debt to GDP ratio, if we use 2019 baseline numbers, of 113%. That's a lot. That means that if you have a house and you have a mortgage, and let's say your mortgage is, and you earn $100,000 a year, you might have a mortgage of $113,000. If you look at it that way, that's not a crazy number. Obviously, there's a difference between government debt and your mortgage and GDP and your income, but that's kind of the way to think about it. So $113,000 mortgage, $100,000 a year in income. That's a lot higher than China, but it's not really that far off of the Euro area, and it's not that far off of the United Kingdom. Furthermore, as we grow this year and into next year, that GDP number, you're going to see that debt to GDP ratio come down just a little bit. And then in terms of the demographics, in the United States, we're actually in a fairly advantageous position because our median age is the lowest of these 5 economies that are surveyed here, and our population growth is the best. A lot of that's due to a more hospitable immigration policy in the United States versus some of these other countries, and also higher fertility rates versus some of these other countries. We also collect a relatively small amount of tax revenue as a percentage of GDP. I think this is good for business. I think this is good for personal income. In contrast, the Euro area, for example, collects 42% of their GDP as tax revenue. This makes it a lot easier if the United States was in a situation where they had to raise more tax revenue. There's more headroom there. In the Euro area, you don't have that headroom. And then finally, if you look at the central bank assets to the debt, there are some concerns that we're financing the debt by just the money printing at the Federal Reserve. But if we're doing it, Japan, the Euro area, the United Kingdom, and especially China are doing it a lot more than us. So we have favorable demographics, and we have a lot more headroom on policy than is often complained about in the press. So if you index these, we normalized a lot of this data and actually came out with a Narwhal sustainability index. And what you can find is we're actually relatively sustainable here at 75, China's at 77, United Kingdom's at 73. To the extent that there is unsustainability on these metrics, Japan and the Euro area will break far quicker than the United States. That's not to say nothing will break, but it is to say there's a long way to go before everything kind of breaks down. Furthermore, you're not even seeing Japan and the Euro area break right now, because if things are unsustainable, no one would want to lend to these economies. But in Japan, the 10-year interest rate is just 0.05%. And in the Euro area, the 10-year interest rate is negative 0.18%, which means that people are not only just willing to lend to these places, they're willing to pay the governments to lend to them. So I don't think that less sustainability on the debt side necessitates higher interest rates in the near term or even medium term, as weird as that sounds. Bottom line for all this is that the U.S. policy is aggressive, but it's not unprecedented. The growth rate of the Fed balance sheet is not unprecedented. The size of the Fed balance sheet relative to other economies is not unprecedented. And if anything, from now on, going forward, U.S. policy is becoming more austere, not less austere. So you're already talking about tapering at the central bank. People are already talking about raising interest rates. This morning, we now have 100% probability that there will be a rate hike by 2023, which is sooner than initially anticipated. And we're also having less profligate spending at the federal level. I think a lot of these stimulus packages are already passed through. And I think that even right now, you're seeing sausage making in Congress take forever to try to get these infrastructure bills through. And I just don't think that we're going to continue to see the type of spending that we saw over the last 15 months. And I don't think that's going to continue. So if anything, things are getting better, not worse, and we're already well within the realms of sustainability. From a business perspective, optimism continues to be strong, but it has tapered off a little bit. And you can see this on the chart to the right, how there has definitely been certain sectors of the economy where there's a lot more CEO confidence and certain sectors of the economy where there's somewhat less confidence. There's a little bit less in technology, a little bit less in the energy utility, in manufacturing of consumer goods. But there's more in government nonprofit space. There's more certainty in the professional service space as things have opened up a little bit more. So revenue and profits, most CEOs expect those to really start to increase pretty nicely over the next 12 months. On the other side, you have a decline in the capital expenditure forecast over the next 12 months relative to where we were in March and April. Part of this is due to the fact that you can't find enough workers to actually work if you're spending on more plants and equipment. You need people to run those plants and equipment. So right now, it's kind of a chicken and egg thing. You need to do the hiring in order to beef up the supply chain. And as a result, what you're seeing is CEOs are kind of declining their expectation on how much they're going to invest in that good capital expenditure over the next 12 months, and instead really focusing hard on hiring just to meet demand right now. In addition, I think there is a little bit of concern about regulatory pressure from the government. You're starting to see that on the farm side. On the chart to the left, you see how concerned are you that changes in estate tax policy will make it difficult to pass your farm on to the next generation. 78% of farmers surveyed in May said they were very concerned. Another 17% said that they were somewhat concerned about the changes in estate tax policy. And you've seen that at the same time, the expectations of farms to invest in new capital equipment and buy new tractors and combines, that's declined from really lofty levels at the turn of the year. So I think that this government policy and talk of more regulation is having an impact on investment, but it's not having as much impact on hiring at this point in time. You can still see this on the small business side. Hiring expectations are continuing to rise, even while capital spending is well off the levels that we saw in 2017 and 18. And what businesses are saying is that at FedEx, you're seeing higher wage rates and lower productivity, which means that you're having to pay workers more for less productivity, at least at FedEx. And that you are seeing the situation begin to abate a little bit, but you still need to beef up capacity. Just because you've gone from 120% of capacity to 100% capacity utilization, that's not really the sweet spot. You want to be in that 80 to 90% of capacity utilization. So you need additional flexibility, and that could hurt profits. In the ISM services survey that comes out on a month-by-month basis, one CEO noted that some employers are actually reporting that they're offering cash incentives of $50 if you show up for an interview. Just to show up for an interview, not even to get the job. just to show up for the interview. And I think in the face of this government uncertainty and investment uncertainty, you're going to continue to see a reversion to what the traditional playbook was, especially in the post-global financial crisis era. And that is to use your cash to buy back stock and buy other businesses. That there's an element of greater certainty with that versus on betting on a new venture. And I think that's what a lot of CEOs will choose to do. And so we are seeing a significant increase in the amount of share buyback authorizations that are coming through. And we're also seeing a pretty sizable step up in terms of merger activity. Goldman Sachs says this is their biggest backlog ever from in terms of mergers and acquisitions activity. I'll give it over to Andrew to talk a little bit more about the household space and what the households are seeing.
All right, thanks, Ben. We want to look a little bit more at the household. We've talked about the government view as well as the business view, and we really want to talk about this third component here, the actual American people and what's going on there, because we've touched on that briefly from a demographic trend level, but there's a lot of cause for optimism. You can see here personal savings of American households is significantly higher than what we've seen historically. This is an area that's giving us a lot of confidence. And obviously, there are a number of factors involved here, some of which may be stimulus money, some of which may be the fact that people in 2020 were not able to get out and actually spend money. But the reality is people saved money in 2020 through this pandemic at a rate that we have not seen previously. In April, American Express was on a conference call, and the CEO noted that the average FICO score of the new U.S. consumer and small business card member is actually higher than those who were acquiring similar cards prior to the pandemic. So people are getting more stable at the household level financially. And you can see this in a number of different ways. Here is real disposable personal income. It's up 5% per capita. Again, you can see kind of the influx of those stimulus checks flowing through, but you can also see the impact here as it relates to how much money is being spent to cover debt. So debt service payments are now below 10% of disposable income, a significantly lower number than we've seen, especially coming out of recessions like you would see in 08, 09. But there's also been a pretty positive trend in this regard. This isn't something that's only induced by the pandemic. You can certainly see that bottom tick there in 2020, but you can also see that really from 2012, 2013 on, we were hovering around 10% and kind of staying relatively stable in that area. This is a positive thing. And when we talk about debt for a country, it's easy to think about what the Fed is doing and printing money and these big headlines that happen kind of at the national level. But we're seeing some stability among American consumers, which when you combine that with demographics that are favorable in terms of average age and the earning potential of the economy, it creates some stability, we think, for markets for years to come. We're seeing all-time lows in credit card delinquencies, significantly lower over time. And you can see really, again, when you think of the last economic recession, look at that delinquency rate that you saw in 2009 and 2010 versus what we've been seeing in the years since and even into 2021. Obviously, there's been some debt forgiveness. There's been abatement in a number of areas, but that's a positive trend that we think will continue to hold. So what are the banks saying? JP Morgan says, quote, strong consumer balance sheet with higher savings rates and investments, as well as healthy deleveraging. Deposit growth was up 32%. This comes at a period at which it was actually difficult for banks to get lending up. They wanted to be loaning more money so that they could make money, but they had few people really entertaining that. American Express notes credit continues to look pristine, better than it perhaps ever has in our history. And that's a recent comment from a Morgan Stanley conference in mid-June. So the American consumer is looking quite strong and relatively well poised to come out of this recession. On the home buying front, that's certainly been a big story as we've talked about home prices. We are seeing here, and you can see in this chart, you can see homes sold. This is according to Redfin in all metro areas, and you can see different years. So the gray is 2018, blue 2019, red 2020, orange 2021. We're certainly elevated, but we're not elevated to a staggering extent on a year-over-year basis. You know, when you look at where we stood in May or June, for instance, in 2021 on that orange line, we're marginally above what we saw in 2018 and 2019. We're significantly above where we were in 2020 because the reality is in spring of 2020, people weren't leaving their home, let alone buying a new one. But we're not seeing this huge rise in home sales because what we're seeing is that supply is tight. So if demand is relatively stable and maybe slightly elevated, but supply is relatively tight, you're gonna see an increase in prices. And you can see similar data here reflecting that in terms of the supply. So what are the factors that cause this? What's happening? And the reality is that we're underbuilt. We've been underbuilt for the last 10 to 15 years. And KB Home offered some commentary on this. They said there's an acute shortage of supply. There's very little resale inventory, and we've been underbuilt for the past 15 years. Demographics are now also starting to be a real factor as the millennials are finally moving out of their parents' basements, and that pent-up demand is finally coming to the forefront as they're looking to buy their first homes. First-time home buyers represented 64% of deliveries for KB Home in the second quarter. We've also seen headlines about institutional investors. Currently, institutional investors own about 2% of the single-family rentals in the United States. It's about 300,000 homes. And there has been activity. We've all probably heard the anecdotal evidence of this. Someone that sold their house to a big company. People saw it sight unseen and they purchased a home. That is a factor, though I don't think it's quite the fear-mongering view that some people are presenting it as. People are not necessarily being completely priced out of the market solely because of institutional investors. But again, we have this result, which is low home inventory. And you can see that orange line representing 2021. You can see here, there's not a lot of supply of homes. We're at a lower level because demand is a little bit higher and inventory remains pretty low. What happens when you have limited supply and relatively high demand? You see higher prices. So the average sale to list ratio across the country, according to Redfin, is pretty sizable. So you can see here that we're actually over 100%. So if you listed a home for $300,000, the most recent expectation is that you'd probably get something around $306,000 for that. And so if you sold a home or bought a home, you've probably seen some pretty fierce negotiations going on, but that's really being driven by a limited supply. There could be an impact of rising interest rates. Ben touched on this a moment ago of interest rates most likely going up. The expectation is now that they will be coming up sooner rather than what was expected. But the reality is even a full 100 basis point move in interest rate is only going to affect the affordability of homes by 7 to 8%. And that's going to take some time. When we talk about interest rates going up, we're not talking about interest rates on a mortgage going up 1%. We're talking about small trickles upwards. So it's going to take time. And we can see that even there, historically, we're still looking at unbelievably cheap 30-year mortgage rates. We've been in that unbelievably cheap category for quite a while. It seemed like even back in as early as 2012, 2013, we thought, wow, 3.5% mortgage, it's never going to be cheaper than that. Well, it actually is cheaper, and it's remained cheaper for some time. So there is still a very favorable borrowing environment for people who are looking to purchase homes. Speaking more on just individual Americans and what they're looking at, we've heard tons of people talking about kind of this bubble in the equity market. There's concern that, stocks are at an all-time high, things have continued to run up. Did we really pay for the damage that the pandemic was going to cause in equity markets? Yeah, it was short, but it was really deep and it came back a little too fast. You can see here in terms of this Gallup poll of where people think the best long-term investment is. Stocks are really kind of hovering right there in the middle. Around 26% of people think stocks are the best long-term investment. So when we talk about an overcrowded market that's creating a bubble, it's a little bit hard to reconcile that story with this actual fact. The fact that most people are not necessarily saying, hey, let's put our money into stocks. More people are going into real estate, at least according to what they think is the best long-term investment. But the reality is stocks are barely outpacing gold in terms of what people think will hold the best long-term investment. So when we think about historical bubbles, it's hard to reconcile the fact that only 26% of Americans think stocks are the best long-term investment with the notion that the market's overcrowded. Lastly, really digging into the data versus the story. We think government policy has been aggressive. but we would be very hesitant to say that it's unprecedented. We just don't think that is reflective of the data. Given the uncertainty, management teams are poised to buy back stock and look for acquisition opportunities. That's been their MO following recessions and when there's uncertainty. Again, not necessarily something new, but something we're starting to see come forward in the data. And this consumer in the US is on very solid footing. We think they're in good shape. New home buyers are entering the market. That's going to continue to take headlines and continue to be something to watch, but also not necessarily a sign of an impending crash. With that, I will turn it back over to Ben.
In this next section, we're going to talk a little bit about the Fed's mandate. A lot of people have been talking about the Federal Reserve. That's what happens when they print money. That's what happens when they have very, very low interest rates. And there's a lot of second guessing of the Federal Reserve. And that's just what's going to happen. And there's a lot of speculation that's made with it. And what we want to do is show what the Fed is thinking and then what we think. And what the Fed is thinking right now is that everything's focused on inflation. And so that's where we'll get started. And Jay Powell on inflation, he said on June 22nd that that's something we'll go through over a period. It will then be over. It actually sounds a lot similar to what a former president once said about COVID. So we'll see what happens with that, I guess. But we'll start off with inflation. And there are really 5 facets of inflation that Jay Powell talks about. And he talks about 5 major reasons of what's driving this inflation that we're seeing. The first is commodities. So we're going to start there. We're seeing on the commodity side, everyone was talking about lumber just a couple of months ago, but lumber prices have now retraced all of their gains from earlier in the year. And this was done at the end of June. And we've actually seen lumber prices continue to decline from those levels. And this was about a bottleneck at the sawmills. Timber prices actually didn't really change all that much, but the sawmills had to get up and running again. And then they were running overtime, and people wanted lumber to build houses, and there was a supply chain bottleneck. So I think for a number of commodities, this is a pattern we could see in those commodities as well. I'm not saying it's all commodities, and we'll talk about some that I don't think that's the case in, but this is an illustration of what happens when there's a supply chain bottleneck and how quickly it can ramp up and then how quickly it can ramp back down. On oil, this is an example of one that I don't think is going to come back like lumber did. And one of the reasons is OPEC. And the second reason is with respect to regulation in the United States. I don't think that at this point in time, we can ramp up supply on a global basis as fast as we were pre-pandemic. There are a number of structural factors for that. First is more discipline on OPEC side. And then the second is more regulation on the US production side. Steel, this is going to be one that should be being watched more closely. I'm surprised not more people are talking about this. But this is definitely one that could follow the lumber trajectory. I would guess that this follows the lumber trajectory more than the oil trajectory, but we'll have to see what happens with this. And the pricing here has moved up a little bit more steadily and over a longer period of time than lumber. And so we'll continue to watch this fairly closely. But I do think that this is an element of supply demand and supply chain bottlenecks that we've seen in other commodities as well. And then finally on corn, this resembles a lot when I first started in the business in 2011, the massive increases in crop prices that we saw at that point in time. That was an amalgamation of a number of different factors, but there was a big drought as well. There was more demand for ethanol and the corn production that provided ethanol due to higher renewable fuel blending credits. So I don't think that corn is going to continue this trend upward, but it could remain here for another year or two, which would actually be pretty good for the farmers in the United States. But I don't expect that the inflation in the corn prices to continue to ramp up to $10 or $11 a bushel. On the bottleneck side, the big one that we can focus on is the mismatch in autos. What's interesting is that in a number of areas, we saw the supply-demand mismatch come to the fore in March and April last year when all the production was shut down. But we've actually seen a renewal in some of those supply-demand mismatches as we've progressed through 2021 because there have been bottlenecks in other areas. So, for example, you can see the blue line, which is supply, and you can see the red line, which is demand. And clearly, supply undershot demand in the spring of last year. Came back pretty quickly. However, in 2021, due to the shortage of semiconductor chips that go into a lot of these vehicles, we've actually seen a decline in production, even as demand has continued to remain very, very strong. And that's causing a dramatic shortage of auto unit inventories. I think you could argue that in 2014, 2015, that auto inventory levels were too high. And they did continue to trend down from 2016, 2017, 18, 19. But at these levels, at 187,000 of inventory units in the country, that is exceptionally, exceptionally low. And I don't think that's sustainable. And it means that prices are going up. You'll go to a dealership these days and you can't find the one that you want. You have to make concessions. Either you have to wait, you have to pay more, or you have to settle for something that you didn't really want. It's really good for people who want to sell their vehicle though. And used car prices continue to rise rapidly. Even today, we saw a consumer price inflation print on used car vehicles that were up 10%. And that's on a month-over-month basis. So used car prices are going through the roof, primarily because we have these production outages and we have the supply to demand mismatch on the front end on the new vehicles. So used vehicles are also benefiting from that. In other industries, we're also seeing bottlenecks, a lot of bottlenecks in the freight side. This is starting to normalize a little bit if you look at that chart on the left. But if you look at the chart on the right, a normal level for this index is about 16, and we're at 65. So freight is incredibly supply constrained right now. It means higher prices. It means higher transportation costs, and those costs will get fed throughout the industry. Pepsi was talking about it this morning, about how they were seeing higher transportation costs, and they're going to be using prices and mix shifts and bottle sizes as a way to mitigate those mix shifts, mitigate those price increases, and then pass them through to consumers. So that inflation will trickle through to the consumer. It'll take some time, but it will trickle through to the consumer, especially as long as demand remains as strong as it has. On the demand side, the big thing that we got was the increase in income that a lot of people had from the government stimulus. If you give someone $1,000 that they didn't earn, they're also less likely to treat it with the same care that they would if they had earned that. And so that's exactly what we saw then, and that creates a demand impact. So this gets to the upward shift in premiumization that we've been seeing. Some of the higher end consumer brands have performed extremely well over the last 6 to 12 months, in part due to this government stimulus that allows people to purchase things that they didn't really need and probably wouldn't have bought ordinarily. But it also increases the demand. And this is especially significant when supply is already constrained. So if you're increasing demand and you have a supply shift downward, then you're going to increase prices, and that creates inflation. And so Jamie Dimon sums this up fairly well. He says card spend has come down by 20% over 2019. Now this has shifted a little bit here over the last quarter, and we're actually seeing card spend come back. But the consumer today has $2 trillion more in their checking accounts. For perspective, as we were talking about earlier, the entire GDP of the United States is 24 trillion. So you're talking about 10% of that in their checking accounts right now. And so he says the stage is set for a very strong economy, very strong demand, because they have to get through all those savings and then they have to ramp up their debt again. That's how Americans are. And that'll take a certain period of time. And I would guess probably at least a year or two, and maybe longer. So that's creating higher demand. The fourth element that Powell talks about is the base effects. So this is when you have very low prices in one year, and then you have more normal prices in the second year. The second year looks like it's having a huge percentage increase, even though it's just a more normal level. And that's what we're seeing in a number of industries. The red line on this chart shows the change in prices of airfares. 24% growth in airfares in May. But that's because they were so low last May. In fact, prices right now for airfares are still well below where they were back in 2020, before the pandemic. So when you're talking about base effects, you're going to see these high inflation prints, but even you might not even be back to the same price levels that you were in before the pandemic hit in the first place. Same is true in lodging away from home. So think hotels. Here, again, price increases are massive. They're up 9%, but the actual price level is still, on this, it's about 157, which is well below the previous index high of about 169. Now, used car prices are up. We talked about this on the Manheim index, and you're seeing used car prices up 30% to very, very strong levels. So it's a great time to sell your vehicle if you have an extra vehicle. If you don't have an extra vehicle, you can sell it, but then what are you going to buy? And that is what's causing the shortage. And that's why we need that production to come online, and we need these automakers to have access to more chips. And finally is the push through inflation. So this is when we see companies like Pepsi or companies like Kimberly-Clark seeing their costs increase, and they have to pass through those prices, those costs, in order to continue to maintain their margin and grow earnings, because they're seeing their profitability shrink. Lennar is actually seeing gross margin increases because they're pushing through price increases that are in excess of these cost increases. So I know a lot has been made about the high lumber prices and tough difficulty to access labor, but that's the myth. The reality is the prices are more than making up for the increasing costs. And we're seeing Pepsi say that too, even this morning, that their costs are going up, but they're going to pass it through in terms of price increases and shifts in packaging. Microchip, a semiconductor supplier, their costs are going up, but what they're also doing is that they have a new supply program where they are locking in customers for more than 12 months of non-cancelable orders. This is not unprecedented in semiconductor land, but it does mean that these guys have a lot of pricing power right now, and they're not afraid to use it. And so that's causing inflation as well. Corning is having moderate price increases for display glass products. These are products that are used in large TVs. Typically, you actually see price declines in this business, kind of the same way you'd see a used car price decline over time, because as technology progresses and production becomes more efficient, you end up naturally being able to charge lower prices for it, and that's what makes the market. But right now, Corning is increasing prices for these products. Even Kimberly-Clark is raising the prices on toilet paper by 7 to 10% in the United States, and that's a huge number for a product that really should be a commodity. But they have the power to pass through those costs, and they're not afraid to do it. So that's what we're seeing on the push through inflation. A lot of companies are also using the inflation concerns as an excuse to raise prices, because their gross margins are actually increasing. We saw it with Lennar, we saw it with Microchip. Their gross margins are increasing even while they're complaining about cost pressures. And the reason for that is that they're raising prices in excess of those cost pressures. So bottom line for inflation, I think the house view is that it is transitory, but we have to be careful. This is transitory, not in a 1 to 2 month sense. It's transitory in a 1 to 2 year sense. So on the commodity side, we have a mixed picture. Some commodities up and down, some commodities are going to stay relatively elevated. In terms of bottlenecks, we're probably past the worst of them, but semiconductors could create some pockets that could last into 2022. On the demand side, we're probably going to be pretty strong. I agree with Jamie Dimon. We're probably going to be pretty strong for a few years. And then on the base effect side, we're probably past the worst, but we still have some significant room to increase prices in airfares and travel and leisure. And then we're going to continue to see costs being passed through, and expect to see a lot more of that over the 6 to 9 months. So that will have a lagged effect on continuing to see inflation bubble along. So my guess is that what we'll see is inflation continue to remain relatively elevated, but with the bubbles happening in different pockets. And that could last for a couple of years.
Good stuff. Thank you, Ben. I also want to talk a little bit about employment and the picture here in the U.S. Obviously, there are employment challenges. We're going to try to get to the bottom of what's actually going on and what's driving those here. So there is a massive employment gap here in the United States. And you can see that we are down 8 million jobs from February 2020 through April of 2021. But amazingly, there's actually 9.3 million job openings as of April. So there's going to be some job transitioning. There's going to be some people that are slower to come back to work. But what is really going on here to create such a wide gap in a period in which unemployment remains elevated, but the number of job openings has never been higher here in the United States? To start off, we do think there's an issue with labor quality. FedEx had a great comment in which they said the widespread labor shortage impacting many companies is also impacting us through higher wage rates and lower productivity. So there is a real productivity issue, and there's many causes for that, not the least of which is some of the mental health concerns coming out of the pandemic. We had a great, I don't know if it was great, but it was a robust report from the Wall Street Journal talking about emergency room visits for different causes during the pandemic. Drug overdoses up 36%, suicide attempts up more than 25%. The percentage of people anxious or depressed was at 38%, whereas in 2019, it was only 11%. There is a real concern about the American worker right now, and it's showing up in the numbers. You know, obviously, this is a transition year politically, and when you look at the single biggest problem that small business owners are facing, according to this survey, which is the chart on the right, you might be thinking, oh, maybe it's taxes, maybe it's government regulation as there's a regime change. But the reality is the biggest concern right now for small business owners is quality of labor. So 26 is the reading there. The all-time high is 27. A year ago, it was 17. People are worried about finding the right people, the right quality of work for their employers. There's a big skill mismatch. Jay Powell noted this in some of his comments. He said there are workers who don't have the specific skills that employers are looking for. NBC News also added the comment, the additional funding employment afforded me definitely gave me a little breathing room so I could explore some other avenues and try to discover my niche. And a lot of people have been doing that over the last 12 to 18 months. People that have been in a difficult position and unable to work or underemployed are really looking to build a new skill set or develop something that's a little bit more unique. You can see that here a little bit in the survey responses. The number of people that say I am out of work now and I anticipate returning to work with the same employer is 42%, but nearly half of the percentage of that are people that are looking to actually go into a new occupation or new industry. So 21% of folks who are currently out of work are really thinking about going somewhere else and doing something different. And you can see that pretty well dispersed across different avenues of work. You know, 65% of people that work in warehousing are thinking about a career change. 29% of people that work in finance, insurance, or real estate thinking about going into a career change. And I highlight those two because you're seeing this not only in blue collar workers, but also in white collar and more traditional office workers. They're thinking about making a change because they've had more time off and they've been working on honing different skills or at least looking into other avenues for which they may want to be working. COVID concerns obviously has been a factor. Although the number of adults not working has fallen, it's still quite high compared to where we were at pre-pandemic levels. And we see that really fleshed out in the data here. The number of people who weren't working because they were caring for someone or sick themselves really peaked out in fall and winter of this past season and has fallen quite a bit, but remains elevated. That's 2 million people that are not working because they're taking care of someone that prior to the pandemic might have been. In terms of people being concerned about getting or spreading the coronavirus, we're seeing that start to trail off and go lower as well. What's interesting is this chart in no way is the inverse of the actual vaccination rate. So we've fallen, but probably not to the extent that would be logical and would really make sense relative to the actual risk and the actual concern. Childcare has also been cited as a concern, and that makes sense. A lot of schools around the country were completely closed or forcing people to, only do online courses for part or all of the week. And so women have actually been slower to come back into the workforce. You can see here that the number has not really trailed off, even as we got into summer. Some of that may be expected with schools typically not open and daycare still not totally back and running. But we've not seen much of a decline there. We've also not seen much of a decline in folks who are caring for an elderly person. And typically those tend to be the females in a household. The final piece that's been cited is the additional unemployment insurance. As most of you are probably aware, that resulted in an additional $300 a week for people who are filing for unemployment. And that's a big difference. We're talking about a very strong additional amount of income that could be earned by not working, specifically related to COVID relief bills. So folks were able to collect up to $2,500 a month rather than the normal $1,200 a month. And that program was slated to roll off in September, but we've already seen some states that have decided, you know what, we're ending this now. Arizona was the first mover. Iowa, Mississippi, Missouri, and Alaska came shortly thereafter. Georgia, a couple weeks after that. Texas, a number of large states have discontinued those benefits, but we're not going to see the impact of that in any real meaningful jobs data that we've collected so far. We're really going to be looking for the July report, which won't come out until August, to see what the impact of this was. When states said we're no longer going to pay the additional $300 a month, it stands to reason that some folks would actually get back into the workforce because they need more income. But we've not been able to really quantify the impact of that early cancellation of that benefit. Another reason is just people are fed up. We talked a little bit about the psyche of people earlier, but we're seeing a lot of people who've decided, you know what, I've had enough of this. I'm actually just going to retire. And so the reason for not working being I am retired has really significantly increased. And we didn't see that early in the pandemic. If you think back to June, July, August, September, we were relatively stable. But going into May, we've seen a pretty significant increase in the number of workers who have said, you know what, I'm just done. And so that's going to be a little bit of a longer tailwind in terms of really impacting, or headwind rather, impacting the employment rate. So when we think about employment, the jobs are there, but where are the people? On the short term, we think the enhanced unemployment insurance is probably going to be a catalyst for getting people back to work now that it's rolling off. We think if some of the child care issues can be resolved with schools being open, daycares being open, we think that's going to help. And we think the COVID fears will continue to subside at an increasing rate. And hopefully that gets people more comfortable going back to the office or back to wherever they're working. On the medium term, we still have that skills mismatch. We've talked about that before, even outside of the pandemic situation. That's going to take some time. There are very few people who were able to study from home and master another craft essentially over a 6 to 9 month period in which they were unemployed. That's going to take some time. It's going to take some time to see labor quality improvements as well. On the longer term, we're going to continue to look at the impact of the retirees. The reality is, if conditions improve, it's possible that a number of those people actually come back into the workforce. It's certainly not incredibly unique to see someone say, you know what, I'm retiring, and then later they go back to work. But we think we'll see improvement in employment in the fall. 2022 remains to be seen, because that's when we'll really be staring down the barrel of some of these longer term impacts like the retiring population. With that, I'm going to turn it over to Sam Frost. He's an investment analyst and a portfolio manager here.
Thanks, Andrew. So shifting a little bit over towards the stock market, a little bit more specifically, we lead off with this quote losses loom larger than gains. This is especially true for Ben, as you can see for the Super Bowl when the Seahawks lost to the Patriots, but it also applies to the stock market. It's called prospect theory. Basically, it says your utility decreases more for losses than it gains for or increases for gains. So it's something we like to keep an eye on. And the one way we do this is following earnings revisions. And as you can see, we had a lot of earning revisions negative through the beginning and middle of 2020. And as you can see on that chart below, that's showing the revisions, I guess, a little bit more clearly. And we all know what happened about a year ago. The market was tanking. And then immediately earnings revisions, we started getting some more clarity on COVID and how this thing was going to play out, who the winners and losers were. And all of a sudden, earnings revisions started moving higher and the stock market recovered as well. A good example of this is Q1 of 2021. The banks really led the charge with earnings revisions higher. And as we all know, the financials did exceptionally well through the first half of the year so far. So it's something we'll keep an eye on. As the earnings revisions go higher, we should expect, the stock market to go higher as well. This is kind of a contrarian indicator that we like to look at. Ben has shown you guys this time and time again. It's the Bank of America Bull Bear Indicator. It's basically to piggyback off of Warren Buffett saying to when others are greedy, be weary, and when others are weary, be greedy. And so when the bull indicator, when the bullish level is exceptionally high, that's kind of an indication that the stock market might be a little bit overvaluated. We've kind of reached euphoria. We think that nothing can go wrong, which really sets a high bar for the stock market and for earnings reports moving forward. And as you can see here, we kind of peaked early on in 2021. We started to come down a little bit and started to level off, which is a good sign. Basically shows that the market is maybe not overextended. There's a healthy level of skepticism, which bodes well for the stock market and kind of provides an opportunity for a potential melt up situation for the market as a whole. So here we have the VIX, it's the volatility index. This is often referred to as the fear gauge. The way to kind of interpret this graph or the VIX in general is this is how much investors are willing to pay for downside protection. As you can see, it's come down significantly since the highs back in March 2020, but still elevated a little bit compared to the years leading up to the pandemic. And so again, what this indicates is we have a healthy level of skepticism within the market, so that, the market people aren't just pouring into the market because they think nothing can go wrong. They're still a little bit skeptical moving forward, which is, again, a good sign for the market. Here we compare the value and growth indexes. And as you can see, you have years where value outperforms, you have years where growth outperforms. And so, this is really kind of key to the way we like to invest in terms of maintaining a healthy balance between value and growth stocks. So we can kind of benefit no matter what the market determines is the play that year. And you can see here in the bottom right for Q1 of 2021 and Q2, growth significantly underperformed value in the first quarter, but then turned around and significantly outperformed value in the second quarter. Again, just kind of highlighting the importance of having a balanced portfolio between growth and value and kind of looking for that best bang for your buck. So with that, we'll hand it over to Tom.
Thanks, Sam. So to rationalize a bit of what we looked at on the last page, the difference between the performances of growth and value in the first quarter and the second quarter, we can really look at what happened in the bond market. So what we're looking at here is the 10-year treasury yield. And we can see we started off extremely low in January, and we saw a significant spike in the 10-year treasury yield really up until the end of March. And that was driven by these rising inflation expectations. And so as inflation rises, so too do interest rates, because people want to make more money on their bonds so as not to continuously lose money as inflation essentially erodes the value of their dollar. And so what we saw there was growth stocks really took a hit. Rising interest rates don't bode well for growth stocks, and we saw a real move into value. But as that stabilized and we actually saw rates fall all the way through really this week, we've seen growth turn and outperform value stocks. And that really has to do with the fact that inflation expectations have dropped. So here we can see the 5-year inflation expectation from the Federal Reserve. And as you can see, in line with the 10-year Treasury from the beginning of the year, we saw a market uptick in inflation expectations really through the end of this quarter. And we've now seen them start to drop. And that's really turned the tide in terms of growth and value in the market. It also shows something to think about is, we have a lot of talk about, oh man, inflation is running rampant. It's going to be excessive. But if you look back to 2010, 2011, when the Federal Reserve under Ben Bernanke had initially done QE1 and QE2, inflation expectations were actually significantly higher then than they are now. And so that's something to be cognizant of, especially when you think of it in relation to what Ben was saying early in the presentation, which is that the moves that the Fed has made are not unprecedented. And if you think of it in relation to other sovereign nations, we really are in a position that is not unprecedented, and inflation expectations, while high and elevated relative to the last few years, they really are not out of whack. So what's going on in the bond market? So this is something that we've really had a key eye on, and that's the fact that the low interest rates over the last couple of years have really pushed a rush for yield. And what that's caused is credit spreads have tightened across the fixed income universe. And what credit spreads are is essentially how much more you're getting compensated for each rung of the credit ladder you're going down. And so what we're looking here is the high yield index, which would be considered junk bonds. So junk bonds are considered sub-investment grade, which means they have a very high likelihood of default. And what we've seen over the last couple of years is not only have the number of bonds that are classified as junk increased, particularly through the pandemic, as well as default rates tick up. But what we're seeing is people are getting compensated the least amount of money really historically ever for these bonds. And so people are wading into the high yield market in search for yield and taking on risk that is unprecedented in the sense that you're getting paid the least amount of money for taking the most amount of risk in the bond market right now. But we actually, in our research have looked at a number of different companies where we actually think that this might be a good idea. And as an example, we've looked at some bonds for Signet Finance, which is actually the parent company of Zales and Jared, the jewelry stores. And they were rated pretty much at the height of the pandemic, 320 of 2020, saying that they weren't going to make it through the pandemic. They were in a really bad spot. Brick and mortar jewelry stores were going to do very poorly in the pandemic. We saw a lot of things like Zales and Jared that were around malls and strip malls that were doing very poorly and potentially gone bankrupt. But coming out of the pandemic, we're seeing that they're actually having record profits. They've switched more to online sales and their balance sheets are improving rapidly, but they have not been re-rated. And so that's an area that we think is worth wading into on very specific names. Despite the fact that yields are historically low, we think there is some value in this space, and it's something that we look to pivot towards should we find opportunities. Now we need to look at the muni bond market. So for Narwhal as a firm, we have an extraordinarily high exposure to municipal bonds, particularly tax-free municipal bonds. And what we've seen through the pandemic is every other area of the bond market has exploded. We've seen, historically large issuance of treasuries. We've seen historically large issuance of mortgage-backed securities and corporate bonds, both investment grade and sub-investment grade. What we have not seen is exploding issuance of municipal bonds. And as a result, there's extremely high demand right now for very clean, tax-free municipal debt. And as a result, the spreads have actually compressed significantly below the treasury line on municipal bonds. So right now they're trading about 69% of treasuries, where they've historically been trading, in sort of that 80% to 90% range. And so that's boded very well for us. We've had exceptional fixed income performance on municipal bonds this year, and we expect that to continue. However, there is going to be a point where they're going to get too expensive to have relative value that we deem as worth wading into. And so that's something that we've definitely got on the horizon is we need to be prepared for a time when spreads do begin to unwind and we see a little bit more spread expansion that we can potentially move into other areas in order to gain value on the fixed income side. And here's an example too, and leveraged loans in space we've talked a lot about internally, and it's starting to become very, very hot in terms of what people are looking at in the sort of high yield sub-investment grade range. And what leveraged loans are essentially collateralized loan obligations, which is essentially very small companies who can't access the capital markets because they don't need enough debt in order to have traditional bonds. What they do is they go to a bank, and then their debt is bundled together with other small companies in order to create securities that people are investing in. And these have actually dropped significantly in terms of their spreads as well. You can see on the chart on the right that we've dropped down about 3.7% yield on these bonds, when traditionally they trade at much higher range, usually twice that. And what's happening here is people are saying, well, these are our floating rate debt. And so if we do see rates rise, they're going to be protected. But what they're not considering is that these are so low on the credit ladder that they're really below investment grade, because they're not even traditional corporate bonds. They're just a bundling of smaller companies' debt. And it's sort of an area that we think to be very risky. So unlike the junk bonds that could potentially be upgraded or re-rated, these are bonds that actually are far more at risk of default. And you can see on the left-hand side, so far this year, we've had $59.64 billion in new CLOs that have been issued, and that's only through May. And so, if you could extrapolate that out, if we keep this pace, we're going to have just exceptional issuance of collateralized loan obligations at some of the worst yields that have ever been, booked on these. So you're basically saying, I'm going to take on historically high levels of very low credit quality debt at the least compensatory point. So you're getting paid the least amount of money to take on the most risk. And so that's something we're watching as well. We've had a lot of clients reach out asking about different products in this space. And it's something that we're very wary of going into the second half of 2021. And with that, I will pass it back to Ben, who will finish this up with market takeaways.
Great work, Tom. Thank you. The market takeaways can really be summed up in kind of that image to the left. Anyone who's seen Monty Python knows that they're just screaming "run away" right now. And I think you're seeing a decent amount of that actually in the equity markets right now. Although equity markets have risen, sentiment is actually still fairly muted. In order to actually have your typical bubble, we're not at that point yet. More buyers would need to come in. Everyone would have to be buying stocks. I mean, you'd be talking about stocks with your Uber driver versus your Bitcoin or your real estate. That's not necessarily happening to the extent that we'd have bubbles in the past. And so for that reason, it seems that the trends in equity markets, at least from the fundamentals, look fairly strong. And on a technical basis, sentiment is fairly muted, provides that melt up scenario that Sam discussed. And then on the interest rate side, on the bond side, I do think we need to be wary about some reach for yield in certain areas. On the corporate credit side, as Tom mentioned, you have very low spreads in corporate bonds, but especially on the leveraged loan side, I think people are really looking at these things and instruments as ways to hedge inflation. But in doing so, in reducing their inflationary exposure, they are also exposing themselves to significantly more credit risk and credit risk that they're probably underestimating as well. So those are the main areas that we're looking at in the market right now. The takeaways from this presentation we want to leave you with is that number one is that the media storylines are only partly true. When you see a story, look at the facts and then skip over all of the commentary and adjectives that they use. A good story always has some element of truth, but is judicious in how that truth is fed out because it wants readers, it wants viewers. And the same is true in the media, and the same is true as in the financial news. Businesses have become a little bit more reticent to invest. They're a little bit skittish because of inflation. They're a little bit skittish because of the supply chain, tight labor markets, and the political side. But this is not going to stop these companies from making money. These companies are continuing to generate lots and lots of cash, and they're going to spend that cash. They might not spend it on new equipment, but they're going to spend it on stock buybacks. They're going to spend it on hiring, and they're going to spend it on dividends and mergers and acquisitions activity. So that's what's happening right now. That's what we're seeing. And although that we do agree that the inflation and high employment may be transitory, we do think that this will come with lingering impacts. And transitory, we need to reset the expectation on what transitory means. And we do think it'll be more like 1 to 2 years rather than 6 to 12 months. Finally, we don't think the equity market sentiment is stretched right now. Even though we're at all-time highs, that doesn't actually mean that we have stretched equity markets. As Sam pointed out, earnings estimates have come up a lot. In fact, earnings estimates are up in the mid-teens this year. And shocker, the S&P 500 is up in the mid-teens as well. So S&P 500 is actually arguably being fairly rational right now. And the equity markets are fairly rational and reflecting the underlying performance of companies. You also have key elements of a bubble that are clearly missing, and those are low personal debt, low corporate debt, and you have weakening investor sentiment rather than strengthening investor sentiment. So that's our view on the markets right now, and I will let Andrew finish up with an update on Narwhal.
All right. Thank you, Ben. Thank you, Tom. Thank you, Sam. As always, appreciate all your hard work on this. And if you have questions, make sure to reach out to us. As a reminder, we do have a morning market briefing call on Zoom every market morning at 8:30. You can find that on our website. Please keep checking that out, and also check out our blog. We're continuing to put out pretty diverse and varied commentary on different topics, ranging from what's going on in the market to specific investing styles and even book reviews. We've picked up a couple new employees since the year began. Natalie Rogers joined us a couple months ago. Don Scola joined us in mid-February in the accounting department. So if you haven't had a chance to do so, stop by the office, get to know them a little bit better. And we do have live events coming back. So be on the lookout for email and updates on Instagram and on the blog about things that are coming up. And we appreciate all the patience you've had with us as we worked hard to kind of get those back in a productive and safe way. We will wrap it up there. As always, if you have any questions, make sure to let us know, and we will talk to you soon.